Okay, good evening, everybody, and welcome. I can see people logging in as I talk. So I am just going to do a bit of housekeeping, first of which to make sure you can all hear me clearly. I used headphones last time and they were a little bit noisy. So can somebody just jump on the Q&A channel and just tell me if I'm clear, if you can hear me. Chat channel's good. Yep. Somebody's telling me it's all nice and clear. But look, if you can't hear me and it is a bit noisy as we go, please let me know. Or if I'm too quiet, if I'm too noisy. Oh, thanks, Steve. Thanks, Kelly. So we'll give it a few minutes whilst people are still logging in, because I can see that happening as we talk. But I hope everybody's having a good week halfway through it. And I guess the big news today was the government, the Reserve Bank, dropping interest rates by 0.5 point. That's 2 drops in one go. So they're definitely trying to stimulate some activity into the economy. And from a property investor point of view, everybody just got a cash flow increase if you're locking in those new rates that will come online over the bank from the banks over the coming days and weeks. So yeah, if you guys, the other thing is we're doing this webinar again, people who missed out in the room events, and it's great that we can offer this service, I guess, because not everyone can make the dates and the times that we had. And to tell you what, the weather was pretty horrible in a couple of those places. So understandable sometimes that people don't want to get in the car and go to a hotel. But it is also nice that we get to see our customers and meet with them and have a drink afterwards. So we will be doing events again in September. So keep an eye on the dates on your email, because we will be going to Wellington, Auckland, and Christchurch again, and I think we are starting regional events in September. But don't hold me to that. So I'll kick into it in a minute. Just a few other things. Yeah, big news today out of the Reserve Bank. And I'll talk about this more as we go. But when interest rates drop, it's great for investors. The only downside with interest rates dropping is that people who are living off interest, i.e., people with money in the bank that live off it, they've just had a pay cut, which sounds weird, but it's true. So often those people then go looking for investments that pay the same as what they used to get or more. So sometimes we see a bit of a shift of deposits down, and that does lessen the amount of lending that the bank can do. So it's great for investors, but it can also put a bit more scarcity on money. And also, I guess there's more people competing for better investments. So sometimes we see people pull money out of the bank, having it on deposit and plowing into real estate. So that's the other side of a interest rate drop. So yeah, but I haven't even had a chance to update these slides because that only happened today. So what you're going to see tonight is exactly the same information that we did last week in Auckland. Well, we started in Christchurch, then we moved to Wellington, then we moved to Auckland. So if you actually are on the webinar and you're doing this again for a refresher, good on you. If not, if it's the first time, should be a bit quicker than last in the room, because I guess I get questions online, but it's a lot easier and faster to deal with them. So I'm just going to check those. There's no questions at this stage. And I'm just going to check one other thing, and then I might get into it. So, I like to sort of do general stuff because I can see the numbers just increasing every few seconds as people log in a little bit late. But for the ones that are here, I'm not going to keep you waiting, so I'm going to get into it now. So quick background. First of all, an agenda for the evening. Why isn't my screen moving? There we go. This is the agenda. We're going to do a bit of a property market update. I'm going to talk about portfolio strategy, timing, a couple of case studies, and the keys to building a good portfolio, and our factory pipeline, what we've got in the pipeline, and next steps of working with us. So as you go, if you have any questions, please write them into the Q&A box, and I'll pause every now and then to answer those. Yeah, this is as interactive as if we were in the room. except we're all sitting at home or in our home offices or normal offices. So what we do, we are what I call I guess a bulk wholesale listing agency or a bulk agency of multiple listings. But if I break it to sort of common English in the world of real estate, we are acting for the buyer in our eyes, i.e. we are negotiating as best a deal or as good a deal as we can on behalf of them before, the difference is we're doing it before they know about the deal. So we're going to developers and builders and saying, right, we've got, 5,000 investors who come to us for good deals, give us the best pricing, give us the best cash back, or give us the best inclusions package, give us the best discount, give us the best terms. I'm always looking for something that I can pass on to our customers. That's how we add our value. No different to buying your car directly out of the UK if it's a British-made car, or straight out of Germany if it's a German-made car. You buy direct. The closer you can get to source, the cheaper the deal you can get. So we use the word volume or bulk to negotiate those deals. This isn't our first rodeo. We've been doing this for a long time. We're now over 2,100 properties that we've sourced. And when I say sourced, we go for the property and then we take those properties to our clients. We've been very active across New Zealand over the last, really the last 8 years. And but before that, we had under different umbrellas or different business names, we did the same sort of thing, but the laws were different then. The rules were, we didn't even need to be licensed in those days. So we also have, we're building a service where you can get access to the best deals first. Often at the beginning of a project, a developer will say to us, right, you can have 2 super cheap, and then we want 10 sold after that. Or at the end of a project, when a developer's got 10% of the project left, that's where their margin is. And quite often, if what I call retail sales, the ones with Harcourts or Ray White or Baileys, if they're slowing, they'll come to us and they'll say, right, here's a discount. We've got one of these tonight I'm going to show you. Here's a discount. Move these to your clients, and it's done through database, email, webinars in the room. So I guess with a member service like that, there's a lot of in New Zealand do the same thing. If you're a Gold Elite because you fly so much, they give you a whole lot of free stuff like car parks, business class upgrades, free Corrie membership, blah, blah, blah. So we're no different to that. And that's how we look at ourselves and why we call ourselves a wholesale listing agency. We like to, this is just a snapshot off our website. So you can look at this at any time. So I won't spend too much time on it. And these are just some of the deals we've done. So every property deal we look at sourcing has an angle. The top left one, that was a developer a long time ago in Wellington, first dual key apartment complex. We negotiated a discount to sell those off the plan, and the people that bought those properties, they got a 37% return. I think that was spread over about 2 years, and that was because we had a bulk listing. We were exclusive to our customers, and that's what happened. Next one along is Northlake and Wanaka. This is the ultimate time to get involved in any house and land packages when it's still a paddock. So we were the first purchasers in Northlake. Our initial allocation was 10 house sites where we didn't buy the land. The land hadn't even been built. We secured the land by paying deposits. We then had houses designed and packaged, and we sold those as house and land packages. Those people made 44% return in just over 2 years. Another one was an off-the-plan townhouse and apartment complex in Christchurch, and again, it was a greenfield site, but these were townhouses and a body corporate, whereas Northlake was a standalone house and land in a brand new suburb. So this is just to give you a taste of the type of deals that we do. Bottom left, that was a one-off conversion from a home into a short stay rental. We don't do that in bulk. It's a service we do as a bespoke service for customers, and we've probably done about 12 of those in the last 3 years. And that one is that was a huge return because it was in Queenstown and the market was extremely favourable. Next one again, like Northlake, Bridesdale Farm, Queenstown. We came into that project that was our first play with that developer, and we snapped up the last 12 sites in the subdivision, and those people got an 18% return. Because it was late in the subdivision, they had a much shorter turnaround than Northlake, and the return was less. However, it happened much faster. It was almost 12 months, and they got an 18% return in 12 months. And I think now, the last valuation we did on those properties, they're now sitting at a 26, 27% return. And then there were some empty apartments that we sold in Wellington that have been sitting there empty for some time, 12 months nearly. And we basically went to the developer and said, look, you're not going to sell these empty. No owner occupiers are going to buy these. It was a purpose-built investment complex. So we worked with the developer to get them tenanted. And as soon as they were tenanted, they sold within about 6 weeks. And that was 13 apartments that we sold in 2014 off memory. So that's just a type of deals we do, and they'll all make sense in terms of why we look for those types of deals when we talk about strategy. But we'll do that a little bit later. Rightio. I used to do monthly updates to customers on the property market because I'm up and down the country, or our company is up and down the country. We spend a lot of money on research. We talk to economists. We talk to developers, research. We've got some developers that are big enough to have in-house analysts, researchers, or economists. So we get a lot of data, and we also hunt and pay for it ourselves. So I like to give customers a update. And I opened this, if you logged in the last 5 minutes, I was telling people that today's news that the government, the Reserve Bank, well, not the government, but the Reserve Bank, the government via the Reserve Bank dropped interest rates by 0.5% today. That's a huge increase in cash flow. Doesn't sound like much, but 0.5%, if you've got $1 million or $2 million or $3 million worth of debt, is huge. So people on floating loans will be rubbing their hands together right now because they just got an increase in their yield. Because as interest rates drop, cash flow goes up. So it's wonderful news. So I haven't got anything on these slides about that, but I have got anecdotal knowledge and evidence that when this happens, two things. New Zealand's investors get happy and they start buying again. And that's what the government's trying to do, not just for property investors. In fact, their target market is actually small businesses. There's 250,000 of them in New Zealand. And property investors are part of that SME, small to medium enterprise market. But the real ones that get the saving, I guess, in terms of their day-to-day are businesses, small businesses. You know, they've all typically got some sort of bank finance, and they've just had if they're floating, the banks will take 4 or 5 days to kick in discounts. But it's very good news for the economy. But it's also a sign that the economy has been slowing, and it's the government trying to keep stimulus, keep activity, keep heads up. So I'll keep popping back to this interest rate drop as I'm looking at a couple of deals. So very quickly, this is a snapshot to the end of June. We haven't updated it for August yet. There's not much difference in August from what I see. But in New Zealand, population is still rising. At the peak, it was 70,000. The average value of a house in New Zealand is 786. That's probably 790 now, or 788. And I guess if you look at New Zealand as an overview, we've still got strong immigration. Where our interest rates, it's the lowest ever in New Zealand today, at 3%. So that's a New Zealand first. LVR restrictions are favourable for new properties versus old. I'm going to talk about that as we go. So what that means is that the banks will lend you more on new property versus old, and that's good news. And unfortunately, the government's KiwiBuild promises haven't been great, and we still have a serious shortage of housing, and that's real. And I see that all the time, especially in parts of Auckland, especially in parts of Central Otago, which were the two areas that got the government's special housing area, SHA classification, where developers could fast track subdivisions like Hobsonville Point, like Northlake, like Bridesdale Farm. So the other thing I'm going to talk about tonight, very briefly, but it's important for first-home buyers or first-home investors, as I call them, and as well as existing investors, just to remind them that big regions are at different stages in the property cycle, and we're seeing a national shift, insensibly, from second-hand property to new, and I'm going to talk about that in depth. So this is just an executive summary of New Zealand. You know, prices are still heading up. There's only a few areas that have gone down moderately. But if you look at New Zealand as a whole, we are tracking up slowly. And that's a good thing in my world. You know, 3.3% national median house prices up by 3%, 41 days to sell. That's steady as she goes stuff. So if I look at, we always look forward as well as back. And if I look forward, we are probably in one of the most changing periods that I've seen in a long time. I think low interest rates are here to stay. You know, we used to pressure test everything at 7%. Well, that's more than double the current interest rate that the government dropped to today. 7% was our sort of cash flow. But made if we pressure tested at 7%, that was good news. Well, every time you see interest rates drop like this, you actually think, okay, well, this is the new norm. You know, 7% is a long way away. So it becomes real, and what it does. So when I said 3%, the OCR is 1%. But what that's going to do when it comes through to the banks, we're going to see interest rates in the 3% as opposed to the 4s and the 5s and the 6s. By the time the banks put their margin on and the etc. But the OCR at 1% is the lowest we've ever had, and it was a double cut. It went from 1.5% to 1%, and the last move was 1.75% to 1.5%. So that's a double cut, which is quite rare. So what's happening there is the world has become a smaller place. In some countries overseas, the bank will pay you to put their money in the bank on a lending front. You know, they'll pay you to borrow money off them effectively. It's crazy. So in other countries, these rates are normal. If not, by the time it hits the consumer in the 3s, other countries you can borrow money in the 1s and the 2s. So we have internationally higher rates still. We're also starting to get more of a flavour, more of a tone in our housing as the Northern Hemisphere. And I'm talking about apartments and townhouses becoming common themed, smaller house lots. People are buying new more than old proportionally to what they used to, because they're getting a lot more aware of the pitfalls of older properties. Properties have a determined lifespan. They don't go forever. And the old Kiwi renovation dream is making much harder to do. And we're finally starting to see some technology hitting housing to reduce build costs. So when you buy a brand new house, it's like a brand new car. It lasts for 10 years without next to anything being spent on it. But if you buy a 1970s or an 80s house, you know, it's or a 60s house or a 50s house, it's much older in its life cycle, and it has a higher degree of required maintenance. And people tend to forget that. So, you know, before I get in the property clock. So one of the things which, for my first 10 years in property, I did nothing but renovate. That's what we did. And we didn't sell anything. We just bought old houses. And in those days, this is in the 90s, we would spend $1 on for every $1 we spent on a renovation, we got 3 back. We just bought a secondhand house. And even though I don't promote buying secondhand, I think your home is different. But somebody has just done they nearly spent their same amount. They paid $1 million for the house, and they've spent nearly 800 on the renovation. So they've almost doubled the spend to the existing house. So we don't have to do anything for a while, but I'm still very conscious it's an old house. I wouldn't do that with an investment property. I would not buy a secondhand investment property unless it's less than 5 years old. and it was, you know, near new condition, because you're getting the latest technology, you're getting the latest health and safety compliance, double glazing, insulated floors, walls, roof, heating, blah, blah, blah. Whereas old houses, it's quite hard to retrofit all that stuff. We put 19 radiators in our previous old house. And as much as it goes against my grain to buy an old house and renovate it, or even buy an old house and live in it fully renovated, it's, you know, when you're in your 50s and you like old houses, your home's a bit different. But from a rental perspective, I wouldn't want to have any secondhand rentals with the way compliance is happening on housing. And that's not just New Zealand, or my opinion, that's the world going that way. And there's a building in Hong Kong, in central Hong Kong, which I grew up there 35 years ago. And it's a commercial building. I think it's 70 stories. It used to be called the Connaught Centre, and they named it the building with 1,000 assholes because all of the windows are round because it's on the harbour. And that building's coming down. It's so out of date now that they're going to put a bigger one in its place. They're pulling it down. So even commercial buildings get pulled down for maintenance. So that's a bit of a theme. So I'm going to jump now to strategy. In the if my mouse will work. It's having a little meltdown. There we go. It's just having to wake up. So some of you will know this, but the property clock is a generic term that a lot of property people use to assess a market. So property is cyclical, i.e., if we measure Wellington over the last 100 years, it's gone up by about 7% on average per annum. Every year it gets about 7%. It's the most safe and steady city in New Zealand. It doesn't get huge jumps and it doesn't get huge drops. So the Wellington property cycle is very different to the Auckland property cycle, which is very different to the Queenstown property cycle, which is very different to the Gore or the Wanganui or the Palmerston North property cycle. Every town, city, and location has a different cycle, and you use the property clock as a way to gauge it. So at 12 o'clock, prices are at their peak, right? And in the perfect world, you'd sell just before then. At 6 o'clock, prices are at the bottom, and that's when you buy. Now, if you're at 1 o'clock or 2 o'clock, prices are dropping. Volumes are falling sale prices, falling volumes, typically from an oversupply or an event of some sort. In 2007, we had the global financial crisis. That was an event, and it was a liquidity event. And that caused a lot of rush on money out of banks. It stopped lending overnight. Banks were going under. Finance companies in New Zealand went under. The good news is the New Zealand banking system was extremely solid, and it was one of the most well-regarded banking systems in the world. Australia was the same, which is typical, which our banks follow the Australian model because most of them are owned by Australian banks. But New Zealand got a huge, huge tick in the box of safe banks. But we still had drops. And that was a global event. It was a liquidity crisis, meaning the lack of money or the scarcity of money. And the world's next event is not expected to be a liquidity crisis. It's either going to be a border issue with Brexit and Trump. It could be a blockchain digital currency event. We don't know. No one saw the GFC coming. No one saw the 1987 stock market crash. No one saw the .com crash. I mean, there was a lot of events that affect property. Now, these aren't reasons not to buy property. We buy property on the basis that it makes sense now and for the next 10 years. And there's ways you can de-risk it. But it helps your psyche, your psychology, your expertise if you're negotiating in a market that you're aware that it's a buyer's market or a seller's market. The amount of times that I get people from out of a location wanting to go in and get bargains when it's a seller's market. And I say to them, I said, you're dreaming. It's at 7 o'clock, at 8 o'clock and rising. You're not going to get a deal. It's seller's market. And conversely, the amount of times I've spoken to developers in Auckland in the wrong location who have oversupply, and I say, guys, you're going to have to discount this to move it. And they go, oh, no, we can't do that. We sold a whole bunch at this price. And I go, no, that was last year or the year before. It's different now. The market here is a buyer's market. And if you want to sell something, you need to meet the buyer's expectations. So I spend my life talking to vendors and developers about where their location is at. And some of them are delusional. And I just say, cool, that's okay. If you want retail, no problem. We can't help you. If you want to move it at a discount, give me a call and I'll walk away. Because sometimes it takes vendors a bit of pain to actually understand that the market has changed around them. Because not all that vendors, developers, builders do the sort of research we do. And it's not rocket science. So this clock is there to help you understand where a market's at. Like Christchurch at the moment has got green flashing lights all over it that says it's a buyer's market. Get in there. But it's scary how many people, especially in the retail market, people that don't go to property courses, don't get property advice, don't read books, people that just want to buy a property because they've got excess capacity on their balance sheet, they rip into a market without really looking at it. And these are the people who pay over the odds. They pay too much because they could be at a 6 o'clock market, but they think it's an 11 o'clock market. They think it's still hot and rising and all the rest of it. So you got to remember, if you're a sophisticated investor or an investor with a number of properties under your belt, you know a lot more than your standard Johnny on the street. So don't forget that. And from a knowledge perspective, I go into every meeting with every developer I talk to with the confidence that I know what I'm talking about, and that they're not going to bullshit me with rhetoric that the property's worth this and the property's worth that. I just go back to them. I say the market dictates the value of your property, and the fact you haven't sold any from the last 10 weeks tells me that you're overpriced. So I have pretty brutal discussions with developers, and I use this model to explain to them. So, you know, it's not like you can sit on your hands and wait for someone to tap you on the shoulder and say, good news, at 6 o'clock, you can buy property now. It doesn't work like that. Same with selling. You know, I'm a property trader and a property investor, and I love to sell at 12, but, you know, I don't have some oracle that, you know, speaks down a megaphone, Campbell, it's time to sell, it's 12 o'clock. It doesn't happen like that. It's a gut feel. It's comments from other experts who I listen to. It's the metrics, etc. But this is just a very useful tool to analyze a market. And just so that you got my views on the world at the moment, I think Auckland in general is at about 11 o'clock. I think it's slowly rising. It's leveling. It's still got some legs in it. And that's real. The legs in Auckland at the moment aren't in the $1 and $2 million properties. Those are at 12 o'clock as far as I'm concerned. If not, they're over. They could have had. There are some suburbs with drops. There's no question. But if I look at infill housing in Auckland, higher density stuff, you know, we're selling properties in Auckland with a 4 in front of them, brand new, off the plan. So that stuff's at 9 o'clock or 8 o'clock. It's the new. That's how we're going to solve the housing crisis. 50,000 houses required. And we've got developers that are buying 3 crappy old houses in South Auckland or out in West Auckland. They're demolishing them and they're putting up 8, 10 or 12 new townhouses. It's wonderful. That's how we're going to solve the housing crisis. It's called infilling or infill housing. And it's or gentrifying an area where older houses are renovated, not by investors, but owner occupiers, and that keeps the value of the location high or, you know, steady. So infill housing and gentrification are the only real solution to New Zealand. And I think gentrification is going to get harder to get because renovating, as I said earlier, doesn't make sense, but retail investors do it. So any questions on this? I'll go to questions now because it's, you know, I could spend an hour on it. You know, I think that Wellington is at about 9 o'clock at the moment. I think it's still got legs. I think that it's had good growth over the last few years, but it was also flat for a long time. and I'll show you that in a minute. But if you've got any questions about this, please type them into your Q&A box, and I'll go through them. I'll give you a couple of minutes. I'll give you a second. Looks like everybody gets the concept, I think. Yep. No questions. That's pretty good. Okay. So please use this as a measure of the market, or the measure of where, somebody's asked where Hamilton's at, so I'll answer that in a second. Someone's saying it's quite crackly. So can people hear me clearly now? Is this clear? I just get anyone saying yay or nay? I hate that people can't, because I could unplug my headphones and just speak to the microphone. Okay. So I actually have got some questions. They've all popped in now. Look at that. So that's good. So first question is, where is Hamilton at? I think Hamilton is, so there's two golden triangles in New Zealand, and I'm not talking about drug golden triangles. I'm talking about property triangles. Auckland, Hamilton, and Tauranga, the North Island's golden triangle. And it's a golden triangle because those three towns have infrastructure spend that is going to link them all up so that it's quicker to get between them all. Not just so people can get to work faster, so that transport operators can move goods, so that people moving between them, so the locations between them are more attractive to live in, places like Te Kawara. People are moving into the regions because it's too expensive in the cities. When that happens, the government spends a lot of money on roads and infrastructure. So Hamilton is the poor cousin to Auckland and Tauranga, but it's an extremely valuable city for a number of reasons. One, hospitals, universities, inland ports. There's a lot of money in Hamilton. Cambridge is 15 minutes from Hamilton, and it's one of the most sought after. It's got one of the most sought after schools in the country. It's got high performance sport. It's got a lot of things. So places like Hamilton are still on the up, and they've got a lot of growth ahead of them because it's a solid city. It's got good incomes, and it's now got apartment complexes. So Hamilton, in our opinion, is an extremely safe investment. And I don't think it's at 9. I think it's below 9 o'clock because there's a lot of infill housing to go in Hamilton. Max has asked where Christchurch is at on the clock. I think Christchurch is sitting at 6 o'clock. I've never seen, and I'll show you that. I'm going to get to this when I show you the regional graphs. I've never seen, apart from Wellington in 2014, I've never seen a city which is just so obviously one of the places to buy. So yeah, Christchurch, Max, it's just so cheap, and it's not going to last. Developers paying twice what they paid for land 2 years ago right now. Dave's asked, what's the difference between apartments and house and land? Good question, Dave. So there are 3 types of housing you can buy: apartments, townhouses, or house and land, right? And you can buy new or old. So if we're assuming new, the difference between house and land and apartments and townhouses is that historically New Zealand has been happy with their safe 1/4 acre, 3-bedroom, 2-bathroom house. That's been the New Zealand product, or even 4-bedroom, 2-bathroom. That's been the Kiwi dream. We are seeing a shift towards townhouses and a shift towards apartments. So there's a big difference. The volume of New Zealand's housing stock is typically in house and land, but we are seeing a massive increase in townhouses and apartments. So they will become the investment product of the future. And if you look at Wellington, apartments yield much more than townhouses or house and land. And I think that Christchurch is probably a little bit closer, but even in Christchurch, apartments yield higher than townhouses and house and land. And that's just the nature of those different products. So what's the difference between the 3? Yield. What's the other difference? Capital growth. In New Zealand, you'll probably still get more capital growth from a house and land package than you will from an apartment. So it's all about trade-off. So hopefully that answers that, David. Shivneil's asked, where is Lincoln at in Christchurch? Lincoln is a suburb, sorry, it's not a suburb, it's actually a town. There's a university there. When I went to Canterbury University, Lincoln was literally a university, a couple of shops, and a bunch of hungover students on the street. it was a pretty basic town. Now it's got very funky cafes, restaurants, bars. It's growing massively. It's a suburb under pressure, and it's one of those places that a lot of people are moving to. Jason's asked if I can provide some information in regards to construction costs being at such a high rate that a lot of developments can't proceed as the margins are so low. So this is getting down to the micro level, and Jason's right. We unfortunately live in a monopoly / duopoly country. National Airlines, we've only got Air New Zealand and Jetstar. And when Jetstar wasn't here, Air New Zealand charged like wounded bulls. We have the same problem in construction, in that Fletchers pretty much control the materials to build houses. But at some point, the government does intervene and starts preventing escalation in pricing, or we get alternative products from other countries. So construction costs are the biggest problem for a developer builder, and we have got an internationally high cost of construction. We can also beat the crap out of the government for the Resource Management Act. It is extremely lethargic. It's extremely out of date. And if you add in the bureaucratic costs in a house and land or a townhouse or apartment, it's actually quite scary. You know, councils get new ratepayers when we build new houses and apartments and townhouses, but the developers, the amount of development contributions, the amount of fees they have to pay to the government when they build a house, internationally we're crazy. It's ludicrous. And that's another area that should get revamped in the next 5 years by the government. And it's overdue. But good question, Jason. Steve's asked if, with the possible slowing of the economy next year and possible repercussions of the Trump-China trade war, if our exports slow and money becomes tight, do you think the Reserve Bank will ease up on LVR restrictions? Good question, and it flows on from interest rates. We just had a 0.5% interest rate drop. At some point, banks will have loan to value, not just loan to value ratio restrictions lifted, because at the moment we have imposed levels by the Reserve Bank. I actually think it will also, we'll start seeing some more restrictions or liftings on debt service ratios. At the moment, the banks are trawling through people's bank statements to look at their actual costs, their actual spend. Whereas in the old day, they'd take your gross income, look at 35% of that, and then work out what you could afford to borrow. That was literally how they used to work out servicing. And LVR, they'd basically add up your assets, take off your debt, or add up your assets and times it by 80%, take off your debt, and that's how much money you could borrow for deposits or more anything. So yeah, there's a lot of talk that these restrictions will be lifted. There's a lot of talks where we think the banks will start easing their monetary policy around debt servicing. But at the moment, it's very hard to get money out of banks. A good question. So I'll just move on, and we can come back to this. We could talk about the property clock and the cycle, or the property cycles and markets within markets all night. I find it fascinating because I think we've got one of the most predictable property markets in the world. Basically, we get capital growth. Well, first of all, we get population growth. That turns into undersupply. That turns into capital growth. And then it all moves south. So whatever happens in Auckland is going to happen in Tauranga, then in Hamilton. Whatever happens there is going to come south to Wellington. The only exception to that rule is Christchurch because of the 2011 earthquake that was devastated this wonderful city. And the other golden triangle that I didn't mention is Cromwell, Queenstown, and Wanaka. That is the South Island's golden triangle. And for the same reasons that Hamilton's always been sort of labelled as the boring town, it's a mission critical town because it's the distribution hub for Auckland and Tauranga and the Upper North Island. Cromwell is the distribution town for Central Otago. And we've seen escalation in pricing there like no other in the last 3 years. And Cromwell is an extremely safe place to buy. because you can drive from Cromwell to Dunedin, you can drive from Cromwell to Christchurch, you can drive from Cromwell to Wanaka, you can drive from Cromwell to Queenstown, all on different roads. So it's extremely flexible where you can get goods into, whereas Queenstown is a very hard place to get goods into. So is Wanaka to a lesser extent. So geographical locations can have a big impact on where government and local council invest money. And the big talk in Central Otago is the airport. At the moment, Queenstown is at max capacity. Last December, they saw 2.5 million passengers go through it. They're forecasting 7 million over the coming decade. 7 million. Now, that can't happen in that current little airport. And the Queenstown Airport Company has purchased all of the land around the Wanaka Airport. They are no questionably going to upgrade it. Whether that's international is yet to be known. But the Queenstown Lakes District Council have also given the Queenstown Airport Company that owns all of that land the same mandate that they've got to allow them to fast forward development. So basically they've got a council level green light to develop in Wanaka. So you're going to see a lot of change in Wanaka over the coming years. And that change is also going to have a huge impact on Cromwell because it's a straight road. It's 30 minutes from Wanaka to Cromwell. It doesn't get affected like the Queenstown or the gorge between Queenstown and Cromwell. So it's a safe bet, Wanaka, from an airport point of view. I think we're going to get wide-body jets into Wanaka. That's my gut feeling. And that's going to have a huge impact on places like Alexandra, Cromwell, Clyde, Kingston, Hawea, Wanaka, Queenstown. And it just is. More people moving down there and more people visiting down there just affects the local economy. So, moving along, if my slides will... Oh, yep, here we go. So this slide here shows... I'm going to stay on the slide for a while because this is why I'm telling people they're mad not to look at Christchurch seriously. If you look at the blue line, that's Auckland. If you look at the black line, that's New Zealand. If you look at the red line, that's Christchurch, and the orange line that is just gone above the black line is Wellington. So if you look at Wellington between 2015 and 2018, that's the steepest growth Wellington's had ever. Now, it doesn't mean it's going to pop. Quite the contrary. Wellington has turned into New Zealand's version of Melbourne. It's got lots of new businesses starting up there in the tech space, in the movie space. I can't tell you how big technology is in Wellington now. When I moved there 30 years ago, there were 200 corporate head offices and the government. That was it. There was no stadium. There was no Peter Jackson. It was a very, very boring town on the weekend. There was nothing to do. Now, it's all very trendy. It's very chic. And there's lots of tourism activities in Wellington to do, and that growth is a reflection of that. I said to about 500 of our customers back in 2014, you're mad not to buy in Wellington. It's only going one way. Get in there. Now, a lot of them did, but a lot of them didn't. They sat on their hands. I got my prediction a year. I was a year early. I thought it was going to jump in 14. It didn't happen until 15. And now we're sitting at a time where Wellington has still got growth, in my opinion. I think it's at 9 o'clock. But it's just surpassed the New Zealand average, which is interesting. And the last time it did that was in 2013. But the average climbed above it. So it doesn't happen very often. It's actually when the New Zealand average surpassed Wellington's. So now it's just flip-flopped. So Wellington's a safe place to invest, highest income per capita in the CBD across New Zealand, including Auckland. And a lot of people moving there for work. It's a cool city. It's like Melbourne. So when I look at these numbers, what I do is I think, right, if the average house price in Wellington is now sitting in the mid-sixes, high sixes, not mid-sixes, level with New Zealand, that's good. Wellington's caught up. It's the New Zealand average. But then I look at the opportunity, and that means it's a good, safe place to buy. Same as Auckland. Even though that Auckland number is so much higher than the rest of the country, it's also carried by places like Ponsonby, Herne Bay, Remuera. Those suburbs push that average up, hence why we're still selling properties for 400 grand, 500 grand, 600 grand in Auckland. We don't sell $1 million properties in Auckland because I don't think they're going to double in the next 5 years. And if they do, great, but it's not an investment property. The yield on those will be 2%, 3% if you're lucky, and that's just not good enough. So Auckland's not a place not to invest. It's in a place to invest with the right stock. But if I look at locations which, in my opinion, are undervalued, you've got the purple graph, which is Hamilton, and you've got the red red line, which is Christchurch. They're actually, in my opinion, grossly undervalued. And I think you're going to see value increases that are steeper over the coming years in both of those locations, especially Christchurch. Look how flat that is. In 2012, 13, it spiked a bit, and that was all the new housing coming on post-earthquake. But then there was a bit of oversupply out the west, a little bit of oversupply in the north, but that's all caught up. You know, the construction numbers the consent numbers have been down. So Christchurch, to me, is a glowing place to get amongst it, and I really believe that. I've just got another question, which I think I'll just have a quick drink of water and answer this one, 2 secs. Jason's asked the question, now that the government has changed the accounting rule of losses being transferred to personal income to get a refund, what's my view if a new build property is negatively geared, so is essentially relying on capital growth for a return, given an investor has to hold for a minimum of 5 years, i.e. Brightline? So a couple of things Jason's commented on there. First of all, ring fencing of losses. What does that mean? It's an accounting term that a lot of people don't know what that means. In the good old days, you could depreciate your house, i.e. you had a 4% deduction that wasn't actually a real cost. You didn't spend that money. It was a deduction that you could get a tax credit for. And if you were a good investor, you would have got that check from the government, assuming you'd paid tax, so you get a refund on your tax paid. You get a check from the government, and you should have gone and spent that on the house to maintain it. I was one of the few. There's a lot, and there was a riot when they took this out. There was property investors and the head of the Property Investor Association. They're all crying blue murder, and poor us and poor us. I actually agreed wholeheartedly with the government because property investors were taking those tax losses and spending them on holidays and cars and boats. They weren't spending it on the properties. With my centre-left social view of life in New Zealand, we have a second-hand housing stock that is a disgrace. We should be ashamed of ourselves. If you drive through Dunedin, the further south you go, the worse it gets. Landlords in Invercargill and Dunedin should be shot. They don't spend money on their properties in general, and those poor students and those poor people that are lifetime renters are living in substandard accommodation, and I think it's terrible. So the government first took away depreciation. What they've recently done, and that was a long time ago, it was about 10 years ago. Recently, though, this Labor government have said, right, no more tax losses going into the pockets of property investors. You can have tax losses, but they stay with the property. Now, what this is forced savings. And what that means is that you on day one, if you've got a negatively geared property, which means the expenses are greater than the income, and you really only want a negatively geared property if it's in a capital growth location, but we'll talk about that in a minute. So just assume your property's making paper losses or real cash losses. Those losses will still give you tax credits, but under these ring fencing rules, you can't credit them against your personal income. So you don't get tax, you don't get a refund. However, if you're a good investor and you're paying your debt off, eventually the property will be profitable, like a business. So if you've got $100,000 worth of tax losses, that's cash banked for the future. So what it means is when you're in retirement and you actually are living off the rent, that means that if you've got $70,000 a year in rent, those tax losses could mean you get paid $70,000 in rent in your hand. You don't pay tax on it. because you've got tax credits to burn. You've got tax credits to spend. So ring fencing, in my opinion, is brilliant. It's KiwiSaver for property investors. It's forcing us to fund the properties in its early years to pay less tax in its later years. So you still get all of the tax benefit, you just don't get it now. So I think it's good. So hopefully that answers that, Jason. And this bright line test, that's got nothing to do with tax losses. What that's got to do with is capital gains or profit on sale of a property. Now, as a property trader, as soon as I buy and sell a property for a profit, I pay tax. That's great. It means I made a profit. I've never, ever heard of a bad profit. Taking a profit is always good. So what the government have said here is these people that are buying houses and selling them after 3 years for a capital gain, bad news, people. We are taxing that gain. And this includes housing and investment properties. So if you buy an investment property and sell it in 3 years for a gain, you'll pay tax on that gain. Now, I don't have a problem with that. And if you're a property trader, you've got two taxes. You've got GST and you've got capital gains tax, or not income tax. We don't have a capital gains tax in New Zealand, but we have an income tax. So basically the government with bright line rules have said, hey guys, we all know you've been taking the piss. We know that you've been buying houses, living in them, and then moving out and selling them for a gain. So right now, we're just putting a blanket rule across the country that you need to own a property for 5 years before you sell it if you want to pay no tax. So it doesn't mean you can't sell a house. It just means if you sell a house for a gain, you're paying tax on the gain. Well, that's okay. What's wrong with that? So a lot of people get confused with these terms and they think it's a reason not to buy. But it's not. It's a reason to start getting real about understanding the tax system and understanding your obligations as a landlord, investor, or property trader. Property traders get this because they buying and selling property, they pay GST, and they pay GST, but they also get to claim GST. But if you're a property trader, you're paying nearly 50% in tax. So negative gearing, bright line test and ring fencing of losses are not reasons not to buy. And if anything, what they probably do is scare out the ignorant investors that are retail investors from the market. So they're probably good for us as wholesale or sophisticated investors. So hopefully that answers that for you, Jason. So coming back to my little graph, this isn't my graph, by the way. This is from CoreLogic or RP Data. This is real, and plus there's a licensed real estate agency. I cannot make representations that aren't real. So all these stats are, they've been ratified by, I get a third party to check them for me. So these are looking backwards. Now, you can't keep looking backwards. You've got to look forward. And you have to make a gut feel or a prediction. And that's what we do with our properties. We only list properties that we believe have some kind of benefit gain in the future, deal on entry. No, we got one deal that's 48 grand on the way in. Forget market growth. So we don't do this because we think it's good fun. We do this because we love it and we're passionate about it, but also because we know what we're doing. So I look at trends. This graph is a 12-year graph. All right, well, it's actually more than that. It's about 2006 or 2005 through to 2019. So, it's 12 years, 9 years, what am I talking about? 2005 to 19, it's 14 years. And those are trends. And if you can look at graphs over periods of time, and we do this, and we look at it and get a feel. And our feel right now is that Christchurch is just ludicrously cheap. I haven't mentioned the blue line. That's the dark blue line, because that's Dunedin. And no disrespect to any Otago people on this webinar. My mother was from Mosgiel, and I used to spend a lot of time down south in Dunedin, but I wouldn't buy an investment property in Dunedin if it was the last place in New Zealand or in Invercargill, because yes, you can get cash flow deals down there, but you've got very limited income sources for your tenants. And I owned a 28-room boarding house once in Dunedin, and the Invercargill Licensing Trust enticed students from Dunedin to Invercargill. I mean, the students had obviously never been there before they left, to be a student in Invercargill that year. And Otago lost 30% of their roll, and we lost 30% of our tenants. And the trouble also with student accommodation, it's not 52 weeks of the year. So Dunedin, beautiful place to live if you're a Southlander or an Otago person. and there's a lot of new housing in there. There's a lot of people moving to Dunedin for lifestyle. But from a property investment place, I wouldn't touch the place. And eventually it will make sense with new property hat on. But right now, I'm not convinced that the population is solid enough for a rental market of new properties. Now, it's had good growth. It's gone up from 300 grand to nearly 400 grand now. And it's not far behind Christchurch. But if you can't compare Dunedin and Christchurch. It's like comparing Auckland to Hamilton, size-wise. I mean, Christchurch is a lot bigger than Dunedin, but secondly, it's got the second 24/7 international airport. Dunedin's not even an international airport anymore, I don't think. So the fact that Dunedin's almost at the same price point as Christchurch is another reason to just show that Christchurch should be up there with the purple line being Hamilton or above. It's just too cheap, and it's because of the rebuild. So buy at 6, not 12. I can't press that enough. All right, wait for my mouse to click over, and hopefully we can get going again. Gosh, it's slow. No more questions at the moment. I'm going to try and get my mouse to... I'm a bit worried my computer's going to have a meltdown. I'm sure it'll go eventually. There we go. I'll try that. So these are really quick. So now I'm breaking this. This is the last 5 years. That was 14 years. This is 5. So if we look at Auckland's median price, what I really like about this is for the last 2 years, it's been flat. That's good. That's really good. And volumes are tracking down, but they're going from 2,500 to 2,000. So that's not out of control. It's not 2,500 to 1,000. So volumes and price in Auckland, I'm actually okay with. It's steady as she goes. It's not looking at a drop. Waikato, as we'd expect, prices have gone up from 300 and something K now to 500,000, but that's only 500,000. That's a low number. And volumes are leveling out. They had a huge 900 houses a year. Now it's down back at 600 and something. So that's okay. So it's what I meant to say is it's mid-cycle. Auckland's end of cycle. Now, end of this current cycle, the new sexy product there is high density living, infill housing, and we can talk to you more about that to explain if you're interested. And it still makes a lot of sense to invest in that kind of product in Auckland. So Waikato's mid-cycle, Wellington's mid-cycle. Even though we've got a steep graph here for Wellington, if you look at sales volumes, they're really steady. And if you look at price point, it's come off a really, really low price point, being 400. And now there's so many people moving there, professionals, 150 plus per annum income earners, that I can see Wellington going average house price or median house price 700, 800. I can see that. So it's mid-cycle. I'll take questions on this in a minute. But Canterbury, the glowing, obvious light bulb that's saying, buy me, buy me, buy me. It's sat at 400 grand for so long. Now, let's go to the world of property development. If you're a builder, you start with land. So in the CBD of Christchurch, we've done over 600 transactions in Christchurch over the last 10 years. And post-earthquake, we've probably done 300. And in the 300 that we've done, I'd say that 70% of them have been in the CBD. We're now out in the region, out in the suburbs, but we are still doing CBD. The developers that we were working with, 7 years ago, were buying land in the CBD for $500, $600, $700 a metre. That same land is now $2,000 a metre. So at some point, when builders' land goes up, construction goes up, labour goes up, they have to put the price up. So there is slight oversupply in certain parts of Christchurch at the moment, but there's also ongoing construction of infrastructure, roads, buildings, infrastructure projects like the Justice Precinct, which is finished, but the convention centre is still being built, the swimming pool is still being built, the stadium's still being built. These are government projects that once they're finished and they take all the hoarding and the scaffolding away, people go, wow, look at this place, it's amazing, and then prices will go up. I would bet pretty much anything that Christchurch is going to go up over the next few years. It's just too glaringly obvious. So if you buy property at the bottom of the cycle, it's obvious. But with Christchurch, because it's such a, not only have you got in a market where people don't like it because there's lots of road construction and noise and infrastructure, and just lots of building. It's noisy in the city. Once that dust clears and the place is finished, people will go, wow, this is amazing. And they want to move there and they want to live there. Kiwis don't really like living in construction sites. So I just can't believe it's not going to happen. And a lot of other property experts that I network with and talk to are the same. So, buy at 6 o'clock. Christchurch has been at 6 o'clock for a long time and it won't last. That's the point. So I'm just going to look. I've got a couple of questions here, some new ones. Just give me a sec. Arif has said, by the looks of today's move of interest rate in New Zealand and India, I didn't know India reduced by 35 basis points. Wow. The indication is recession. If so, what is the impact on property? So I haven't actually seen the word recession in the paper for a while. And I guess I don't believe we'll have a recession because we've got such a housing shortage, and housing is such a big fueler of money in the economy. 50,000 houses, which has been bandied around for so long, and we haven't built that many. We've got a long way to go. So builders took us out of the last recession, and I don't think I think it's going to prevent us from getting into one. Now, I don't know if that's the case. I mean, at the end of the day, the definition of a recession is a combination of a number of things. And at some point, the government can say we're in a recessionary market. But because we're all in property, and because that's our business, and the tenants have to live somewhere, I can't see that market changing. We've got drastically high levels of home ownership decrease in New Zealand. So the tenant market's only getting bigger, and we've got a shortage of housing. So until we can start building houses quickly, I don't think there's any oversupply in general in New Zealand overall. And until we actually start getting first home buyers, tenants buying housing, and our home ownership rates increasing, I don't think we're going to see a recession in the property market. We might in the general economy for the 250,000 SMEs, but I don't think we're going to see it in the property industry because, when you build a house, they do come. People, we had our biggest project was 67 units in Christchurch, finished all at the same time. 4 weeks later, or six, I think it might have been 6 weeks later, they were all tenanted. The 13 units that we sold in Christchurch in 2015, they were dual key apartments, so there were 26 tenants. They were rented in 10 days. So I don't think we're going to see the world of recession in the world of, the term recession in the world of property, but a recessionary economy does have an impact on things. People do get laid off. People income pay increases don't happen as frequently. But it's the first time I've heard that word, so I don't think we're there yet. And again, I don't believe in waiting. I believe in acting right now. And with 0.5% in interest rate drop today, that just made the yields go up. And that's the sort of way I look at it. So just for the first timers and the newbies, I am going to just go through a quick, very simple strategy. There are a million books on property investing. Dolph DeRue's, Robert Kiyosaki. There's so many people and commentators, Martin Hawes. There are so many people in the world of property who have written books about, build a cash flow base and then add capital growth properties, have a balanced portfolio, have a acquisition plan. When you've got the ability to buy 3 properties, buy them at 6 o'clock. We say on average you should buy 5 properties over 5 years. Well, that doesn't mean you should buy 1 property this year and stop and buy another property next year. It comes down to your current financial circumstances. So every single investor or want to be investor or about to become investor has a separate set of financials: income, equity, age, risk. There's a whole bunch of things to the blender, and out spits your risk profile. And we can help you do that. We have a product that helps you do that. But if you look at the standard property investor, they typically buy 5 properties over 5 years. And they hold them for 10 to 15 years, which is typically 2 cycles. And then, if you look at this growth chart, this is showing that if you bought 5 $500,000 properties with 2.5 million of value and 2.5 million of debt, in 2 cycles, they'll turn from 2.5 million to 5 million, then to 8 million to 10 million. And this is using typical capital growth, typical inflation, typical numbers. But the numbers look crazy when you think, how can you turn 500,000 into 17 million? Well, it's called property cycles, inflation, and capital growth. So as long as you build it properly, i.e. you have enough cash flow to fund them, this is a very simple and basic way people in property make their money. You live off the rents, which are inflation adjusted for the rest of your life. And my 86-year-old father, he is a seasoned property investor. He's been living off rents for over 25 years. And he retired early as a judge in Hong Kong. But I see a lot of people in property that retire early through sensible investing in their early years. So you don't have to be a rocket scientist to do it. Property is a business, and you don't need to overcomplicate it. Now, I'm not saying everyone should just buy one property this month and another in 12 months' time. I'm just saying this is your standard, how someone looks in 10 to 15 years if they do the smart thing and buy 5 houses, 5 properties, 5 apartments, 5 townhouses, and hold them for 15 years, 2 cycles, pay off the debt, and all of a sudden you're living off $2,500 worth of gross rent per annum, per week. If your average rent's $500 a week, it's 25 grand a year on average. 5 of those, pay your rates, insurance, you got a pretty good income. And that's literally property 101. And it's what most commentators teach. It's a low risk, easy way to buy property. So I'm just showing you now some examples of the types of properties that we sell. So these were some townhouses that we negotiated 4 of these. The developer was selling them for $390,000 each. We said, give us a really good price for 4. We got them at the right time. They said, right, you can have them for $320 each. They knocked $70,000 off each one. A good deal. So that was $280,000 in one hit. That was a big discount, but at the same time, we got them. This is a few years ago. The market was pretty flat, and it just worked. This was one that our clients did. That's North Lake Wanaka before it was developed. You can see all the dusty, browny, light brown color. That's roads going in. And basically, we got in. I was their first customer. I was the first purchaser in that development. They released 60 sections on day 1. I already pre-purchased 10 of them. And I'm up to about 40 houses in there now. And we were buying land and the houses for 500 grand. To do the same thing now is 700 and something. Still makes sense, but that's capital gain in greenfield subdivision if you get in early. Bridesdale, Queenstown, same sort of numbers, shorter period of time because we came in at the end, whereas with Wanaka, we came in at the start. Bridesdale, we came in at the end. Still a pretty damn good return in 2.5 years. Actually, I think it was shorter than that because the titles were, I think it was about 1.5. I think Wanaka was 2.5. Yep, that's 2.7. Bridesdale was 1.7. I need to change that slide. And then Wellington, over 2 years, whilst this apartment complex was getting built, they jumped from 350 a unit to 480, 37% return while the builder builds it. And in Queenstown, this is just an example. It's a one-off. I had 2 of these personally under contract. So this is not a client. This is me. These were pretty boring 2-bedroom, 2-bathroom townhouses on Frankton Road. And I thought, shit, these are pretty cheap, 500 grand. So I locked 2 of them up, one at 505, one at 550. I did my due diligence on them, and I was overly conservative, so I let one of them go. I bought one at 505. We were going to spend 100 grand on it, converting it from 2-bedroom, 2-bathroom to 3-bedroom, 3-bathroom. We didn't do that. And because the market just moved around us so quickly, so in 14 months, it went from 505 into the sevens, and we just thought, no, we're not going to renovate that. That's crazy. Because even the renovation, whilst it made sense because it was going to become a short-term rental, it was still bloody expensive for what it was. So we debated for about 2 weeks whether we're going to keep it or sell it. And we took that property to auction. There were 18 bidders, and it sold for $785,000. That's a $280,000 gain in 14 months. So I guess I'm showing that. I'm not gloating. I'm just showing that these deals happen if you buy at 6 and sell at 9, 10, 11, 12. And we've got a heap of examples on our website that you can see of past deals that we've done. And hopefully you can take some time to look at that. So I'm just going to have a quick look to see if there's any questions. I think I've got a new one. All right. Nope, no questions. But feel free to ask questions as we go, because I am looking at them and I'm going to answer them as we carry on. So why? Okay, so I'm now giving a little bit of insight to our engine room. We don't just I've got a lot of real estate agents that are good friends. I've got real estate agents that are in my family. My cousin's a real estate agent. Yet I have never ever worked for a retail real estate company. And if you look me up at the REA, I own 3 real estate companies, and I'm not your typical agency, because when I meet with developers, I grill them. They can't. It's almost comical because they go, man, we've never met anyone like you, because you ask us so many questions. You ask us how much equity we've got. Most agents are down on their knees groveling for a listing. But most real estate agents in the retail world are what I call list and hope. They want to list a property and hope like hell it sells. And when I say this to developers and builders, they laugh, because they play agents off against one another, and they have this little dance. But the reality is those agents are typically sticking it on Trade Me and realestate.co.nz and hoping like hell buyers come from those mediums and buy property off them. And it's real, they do. That's what I call a retail buyer, a retail investor, or a retail purchaser. And you're mixed in there with mum and dad homes, investment. There's no investment section on Trade Me. Can you believe that? It's just crazy. In some areas in Auckland, investment sales are 50% of the market, 50%. And Trade Me still don't have an investment button. But that's okay. It's a multi-billion-dollar company, so they're doing something right. So if you look at how real estate is structured in New Zealand, it's so old-fashioned. So when we're looking at investment property, every single developer thinks their product is the greatest product under the sun. They're all convinced of it. And they tell you all the crappy things about their competitors' products. And then we talk to their competitors, and their competitors tell us about all the crappy things of their products. And it's just so pathetic. And I sit through all this and I laugh to myself, thinking, my God, if you only knew what we put you through. So we actually look at, for every 20 projects we look at, would probably take 1. So I'm constantly looking at lots of properties. And every developer tries to convince me it's the greatest project under the sun, as I said. And I nod my head and walk away, and I send them an email saying, thanks very much, but we can't sell your property. So this is an insight to our selection criteria for the listings that we deem worthy of putting to you as our customer. Okay. And the number 1 isn't a typo. I've written it 3 times because the old saying, location, 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 is true. It is all about the location. So that's the first rule in housing. But when you jump to investment property, there are a few other things you need to look at and think about. The next one is infrastructure plans. Is there a train station being built near you in the future? An underground? Is there a bus route? Is the government spending money taking people away from this location or taking people to this location? What's happening? What's going on the infrastructure? Infrastructure being schools, roads, major roading corridors, trains, transport routes, public amenities like swimming pools, concert areas, picture theatres, things that the council will build or the government will build for the location. We then look at the developer's DNA, and you'll be surprised at how many people have phoenixed themselves from being a shark of a developer into, oh, I'm the new guy on the block. We look very hard at the company's office. We ask around, we go to unofficial networks, and we find out who's got the good record and who hasn't. Startup developers, we have a separate set of criteria on them, and we will take them on, but they've got to prove to us they've got a decent, solid equity investment in their own projects. It's not all someone else's money. And we want to know what the hell they've done and why they're a startup developer and who they used to work for. We then pressure test the area they're going into, the location. I have told developers before that they are mad buying a piece of land in a certain location. I spent 3 years as a developer, and I think I've done them the biggest favor. Often they still soldier ahead and buy it anyway. I help developers with floor plans. I help developers with, that's number 5, product quality and design. I've probably designed 3 projects in the last 12 months with developers where I've said, like, you got the design wrong, do this, do this, do this, and this. Because I know what tenants want. I know what landlords need. And we have a pretty rigorous internal selection criteria. So by the time you get a property that we have packaged up and have made available for sale, often we've been involved in it for a year. Because at the end of it, all I care about is that you end up with a rental property that's rentable. All I care about is you getting a rental property with a tenant in it. You know, you can have the nicest looking property in the world, but if it's vacant 50% of the year, that is an absolute disaster. So I ask all of these questions, and often the developer doesn't know the answers. So I go and find out myself, who is the target tenant? I don't rely on the developer to do this for me. Make sense? Hopefully. So one of the things which we have moved as a business, we don't do secondhand, okay, unless it's brand new or, you know, it's been sitting there empty. So if we look at how we sell to clients, we've gone and beat the crap out of the developer to get the best price. We've got a volume discount, but then it's I see a lot of good deals get lost because the lawyer or the accountant hasn't been comfortable with body corporates or off the plan purchasing. And those lawyers and accountants are typically non-property lawyers and accountants. If you have a lawyer that's savvy in the world of property, they're very, very familiar with off the plan selling. They're very familiar with off the plan contracts. And when you think about this, when they changed the deposit rules in New Zealand on off the plan purchasing after the global financial crisis. So the good news there is, if a developer goes under while they're building your apartment complex or your townhouse complex, your deposit is safe because it's sitting in a lawyer's trust account, and the lawyer has a fiduciary obligation to give it back to you if the development fails. So the only risk is that your money is tied up in a trust account, typically earning interest for some time. That's the only risk. Let's look at the risk from the developer's point of view though. They've typically bought a piece of land or they've got a position on a piece of land. They have spent a shitload of money on development consents, resource consents, building consents, architects, lawyers. They've got a lot of money already. Secondly, they're susceptible to exchange rate risks on materials being imported. They're susceptible to material costs, labor costs, bank costs. The developer is taking huge risk on an off-the-plan sale because they're basically securing you with a price today for a property that may take 12 months, 18 months, 24 months to build. That's hard to do. So one of the things that people forget is that when they sign up to a property off the plan, you know, someone else then is taking on the risk. And there's a whole lot of horror stories where projects have expanded out or cancelled, or people have had to ask them for more money. Well, that's better than the people losing their money. So, you know, we're of the view that off the plan is great because you get the benefit of market growth. And you look at Christchurch, it's flat at the moment. If I'm right and it starts moving, you know, early next year, the properties you're buying now, which won't be finished till the end of next year, should get capital growth before they're complete. Now, if you do that, it's a bonus. I don't count on it. But if you bought $1 million property in Auckland I don't think it's going to double in the next 12 months. In fact, I'd put my reputation on the fact that it's not, if it's $1 million property. But if you buy a property for 475 or 85 grand off us today in Auckland, I'd almost take the Pepsi challenge that it will have gone up in value significantly in the next 2 years. So it comes to location strategy and what you're doing. And the one thing about off the plan purchasing, we're negotiating discounts with developers on an off the plan product. And that's rare. That's really rare. Normally we're selling at valuation, but the valuations are typically conservative. But we've got one I'm going to show you in a minute that's actually discounted now, and that's off a valuation that's off the plan. I think I've got some more questions. And I'll go to them. There's quite a few actually. I'll come to them in a second. So that's buying off the plan, okay? And it's a common strategy, and I think you should all do it. Just before I get into some questions, please check out our website. We've spent quite a lot of money on this, and that's not the reason to check it out, but there's a lot of resources in there. You can fill out in about 10 minutes your information, and we will send you a free property strategy. Okay, it's not financial advice that's specific to you. It's a general property strategy based on someone with your range of incomes and equity and debt, etc. So this is a perfectly legal thing we're doing, but it just gives you a better insight to your own financial circumstance. And after that, you can get a paid one from an authorized financial advisor that we can facilitate, or you can engage with us and we can have a discussion around it. So that free property strategy will take you the whole 10 minutes to fill out online. You won't get the strategy then, you just fill out some information. It's confidential, we keep it private, and we keep it secure. We'll give you a financial health check. You can get access to our, so if you sign up as a member, you get access to an area of our website that shows our new projects coming up and our new releases. You'll also get access to our advisory network. One of the reasons that we did this was that so many people would snatch defeat out of the jaws of victory by using the wrong lawyer, the wrong accountant, the wrong property manager. And it's so dangerous. So advice here is we give you our top people and they help you make good decisions. We have invites to webinars like this. We'll give you market updates on a monthly basis and podcasts and videos. There's a Facebook members only group, and we have a members retreat. So we've got 2 tiers of membership. We've got a free level and we've got a paid level. And when we help you as an investor, and this is all on our website, we take you through a 5-step process because we know property can be scary. We know property can be it's a daunting exercise for some. So we set your strategy at the start. We take you through an asset structure that will be signed off by an accountant or lawyer. We'll send you off to the right finance person. We will help you select the right property, and then we'll hold your hand through to settlement, especially with an off-the-plan process. So I'm just going to answer some questions which I see have come in. Okay, we've done the interest rates one. Somebody's asked me about a project in Christchurch, which I'm an owner in as well. It's on Draper Street in Richmond. The question is, do you rate it as a success? Yes, I do, Max, because they're fully rented and they're still very new. They're just over a year and a bit old. And Christchurch has had, as you saw on the Christchurch growth chart, it's flat. And it's flat because Christchurch is a construction site. But if you look at the suburb of Richmond, and for those that don't know where Richmond is, if you're looking at Christchurch from above, Richmond is in the northeastern fringe of the 4 Abs. Now, these properties were bought, they're 2-bedroom, 1-bathroom townhouses that were sold with mid-3s in front of them, brand new, only 8 in the complex. So, yes, I do, Max, think that these were successful because they haven't had their day yet. And, it's a project like a lot of them in Christchurch that they're flatlined. They're just chugged along. But, when they go to 500 or high 4s, people will be happy. So the thing with properties, you can't force capital growth. You can't force properties to go up. It's the market and it's the retail investors. But what I'm seeing on at the moment, and everything starts in the middle of a city and moves outwards, I'm seeing prices under pressure with land values going up. And I really do believe that we will see capital growth in places like Richmond, in places like St Martin's, or sorry, Waltham, St Martin's Green, which is another project we're involved in. So I honestly believe they're all going to go up. And now would be a terrible time to sell them. Another question. At the moment, I have, I won't mention the number, quite a lot of money worth of equity, but serviceability is the issue due to the less than desired income. Okay, the person that asked that question, I spent 3 years as an investment lender, and one of the greatest things that I learned a long time ago was the relationship between servicing and equity. Most people in Auckland are what I call equity rich and cash poor. Their properties have doubled or tripled in the last 5 and 10 years, and but the bank's saying, no, sorry, we won't lend you any more money. Your income is too low. Now, it's far easier to replace income than equity. Max was asking us about these properties on Draper Street. I can't make them go up in value. I can increase their income, but if you look at them as standalone investments, these properties wash their own face. The rent on the cost, cash flow neutral. So that's good. If you had the same property in Auckland, it would be cash flow negative. So you need to buy, the person that's asked me about this, you need to buy the right properties, and yes, we can help you with that. So please contact us and we will put you in touch with one of our team. Kelly has asked about Hobsonville Point. I know parking is a huge issue there, and Hobsonville Point is where the block was filmed, or the early blocks, but it was also New Zealand's first special housing area. It's the old Air Force site on Whenuapai. And it's basically, in my opinion, going to become a big town in its own right. I was there last week. So I think Hobsonville Point is in its early stages, Kelly. I think it's really early. But man, it was busy when we were there last week in the middle of the day. The school's open. The school's got kids in it. Parking's an issue, but they don't want too many cars there because it's also a very tenant-focused location. And people get the ferry into the city. You can get buses. The world is moving away from vehicles. And as a guy that owns too many vehicles, I struggle with it. But when you go international, you'll never, if you go to Hong Kong or Singapore or Malaysia, you will not rent a car. When I go to Auckland, I curse every time I rent a car and take it into the city because there's nowhere to park the damn thing. So I'm going more to Ubers and public transport, taxis, you know, even running around cities. I run around Christchurch on Lime scooters. It's just this flat, it's easy. It's on a nice day, it's a nice way to watch the world go past. So I think Hobsonville Point is one of New Zealand's greatest housing developments. And I think Ngāi Tahu, who have done a lot up there, have been exceptionally good. I think the major developers that bought the super sites have done a great job. So I think you're going to see more Hobsonville Points. I think it's the solution to our housing crisis, to be honest. But they take a long time to get out of the ground. And if you look at North Lake Wanaka, 1,500 sections, that's the sort of equivalent in the regions. So I'm big on Hobsonville Point. I think it's a good place. I'm also big on infill housing in West Auckland. So again, this is where we look at location. And Hobsonville Point is an area. I mean, it's very rare that you get that much land. So they've carved it up very well. They've thought about it, and it's got certain areas. It's got the hoity-toity area with the high net worths. It's got the medium net worths. It's got the low net worths. And it sounds hierarchical, but that's the way housing is. Christchurch has Fendalton and Aranui. Wellington's got Cannons Creek and Oriental Bay. Auckland has Otahuhu, or that's actually a good suburb now, I'm picking the wrong one, Takanini or Henderson, and it's also got Remuera. So Hobsonville Point, you got a bit of everything in there, but it's all new, all brand new housing, and it's, in my opinion, wonderful. Someone's asked me about a development at Parata, can't pronounce it. I actually don't know it. Haven't looked at that one, I'm afraid, Elaine, so I can't comment. So, but one of our team may have, with Auckland-based team members, they may be able to help you with that. So contact us and I'll put you in touch with our Auckland investment advisor. So listen, we've got free, you can sign up tonight or anytime and you will get all of the stuff for free. We've spent quite a lot of money on our website and we are really we want you to engage with us. We want you to become better investors. We want you to become a more informed investor. So we've put a whole lot of free stuff on our website. It wasn't free to us, by the way. We spent a lot of money on this. And the ones with the ticks there you get for free. So please sign up and we will help you. For the people that are serious, we have a bunch of extra things that you can get as a paid member. And I won't bore you with this for too long because it's all on our website. But the things that you get for free, you get an annual portfolio strategy review by us. And we will do an annual valuation and cash flow review of all of your properties. I mean, that's quite expensive for us to do that. But again, if you're a serious member, we want you to become a serious investor. If you're a serious investor, we want you to become a safe and long-term investor through good advice and guidance. And that's where we come in. I guess the key thing here is you get to see our deals before the market. So that's if you're a paid member. That's probably the most critical thing in here, in that you get the deals before they go to the free database or before we just send them to our bulk database. We've got a select group of property professionals. One of the things that we're looking at doing, hopefully this year, is creating advisory boards for our customers so that they've got third parties keeping them honest. When I was a developer, we engaged Fran Wild, who's an ex-cabinet minister and the ex-mayor of Wellington, as our chairwoman. And every month we would have board meetings, and we would report to the board, and this was for our own investments, our own developments. But we had $180 million worth of projects underway, and we wanted someone to keep us honest. And I think that every single property investor who owns more than 2 or 3 properties needs an advisory board, because they need someone to steer them, keep them honest, keep them on task. And a formal board's probably too much. If you have 10 properties, I think you should have a formal board. But if you've got 2, 3, 4, 5 properties, I think you need an advisory board. So it's one of the things that we're going to launch hopefully this year. And every single customer who I've run it past is saying, great idea, I'd love an advisory board. So we're just putting them together at the moment in terms of how that will look, what it will cost the customer, and how we will facilitate it. But that's the sort of thing we're going to do, because property is a business. There are 250,000 small to medium enterprises out there. And I did a quasi-MBA through the Auckland University, and they said the thing that lacks the most in New Zealand is corporate governance. And advisory boards are a great way to keep business owners on the straight and narrow, keep them focused, keep them accountable. And it's a big thing for me. So I'm looking forward to that, putting that together. So we have a Platinum Members Facebook group. We also have an invitation-only 2-day retreat 3 times a year. And I think the first one of those is September. No, don't quote me. I don't know. We're going to have one this year. So this is what you get if you're a paid member. Let's just see what we've got in the pipeline at the moment. Actually, I've just had a few more questions. So I might just have a wee pause here. Thanks, Elaine. She's told me that Parata's in the Pukekohe area. Pukekohe is pretty hard to beat anywhere down that way, because they're basically improving the road between Auckland and Hamilton. Pukekohe is south of Auckland. And, you know, it's probably quicker to go from Pukekohe to Hamilton than it is from Pukekohe to Auckland now. So I think a lot of people who work in Pukekohe will start looking at buying houses in Hamilton. Someone's asked me, if you bought a dual key apartment in Wellington, nearly completed, will you hold or sell it now or in 1 to 2 years? Janine, I can't answer that, because depending on whether you're a trader or an investor, it would depend on your financial situation. I'll tell you something for free though. If you bought a property in Wellington off the plans 2 years ago, you are pretty much guaranteed capital growth by the time it's complete. So that's good news. So you've got a nice problem to have, and we can get our investment agent, Kylie, to talk to you about that. So please just send us an email and we'll put you in touch with the right person. My gut feeling is keep it, because rents in Wellington are on the rise. But again, I don't know your circumstances, so it's very hard for me to advise. And we don't give financial advice, we just give opinion. Okay, so we've got investments across 5 locations. We have a mixture of cash flow and capital growth properties. There's a big difference. Cash flow, keep the cash flow positive. You don't have to top them up. Capital growth, you typically have to top them up. Each investment has its own economical driver, and not every deal is a great deal for you or a bad deal for you. There's no such thing as a good investment deal. Investment deals are matched to investment purchases. And your strategy and your financial circumstances are different to the person next to you. They're different to the person that your neighbor. Everyone's got a different set of circumstances. So what we do is help you with our partners work this out. And that's what we do. We are basically a company who assist customers into the right property through matching it to their financial circumstances. And that's where we use other people to help us with that, whether it's an authorized financial advisor, a mortgage broker, a cash flow expert, an accountant, and sometimes a lawyer if you've got a complicated set of structures. So we kind of massage you through those different people. And when you come through the end of it, you are really educated. You completely understand what kind of property you should be buying, and it will help you save time. It stops you mucking around with properties that you can't afford or that you shouldn't buy. And once you get the right team of experts on your case, you'll be surprised at how quickly and informed you become. And the people that are on this webinar who have dealt with us before and been through this process, they'll know what I'm talking about. And if you haven't done it, at the very least, please fill out those free property strategy forms, because we'll send you a 5-page report for free that tells you a little bit more about you. So I hope you fill that out. Oh, my old mouse is sticking again. You've been very patient with me on that though. There we go. Henderson. So this is a snapshot of some of our deals. Okay, we've got more deals than this, and we've got more deals coming on all the time. So this is an Auckland townhouse, brand new, in the middle of Henderson. We drove past it last week. It's not built yet. Yields from 5% in Auckland. That's pretty hard to get. 20 minutes from the CBD, settles late next year. There's only 7 available, very small project. And we've got a $10,000 cashback negotiated from the developer on this towards your first year expenses. So you will not have to top up your mortgage on settlement. And I'd say these will rent pretty quickly. When I say top up the mortgage, whilst the property is empty while you're getting a tenant, you've got a $10,000 cashback from the developer, which is pretty good on a $465,000 purchase. So that's one of the deals we've got for you. The next one is Te Atatu South in Auckland. Similar numbers, 450, settling late next year. Another same developer, $10,000 back. There's only one of those left, if that. But they've got another site coming up over the coming months. Christchurch, this is our deal. We've got 48 grand of off the plan discount. Now, these aren't going to last. We've got a special offer where the developer has basically guaranteed an interest rate through a developer contribution so that they're cash flow positive. And what that means is if you're paying 4% interest, the developer will write you a check for the difference between 3% and whatever your current rate is. Or they'll guarantee it at 3%. I mean, if you're paying 10%, they're not going to make the difference up on that. But they'll basically guarantee you 3% with a cashback that is basically covers you for 3 years. So there's a discount on entry. There's the cashback on the interest rate. So this is a pretty damn good deal. We don't get these very often. And it's brand new in Christchurch in Riccarton Park, which is 10 minutes from the airport, 6 minutes from Canterbury University, 12 minutes from the city. So if you're an Aucklander watching this, those are real numbers. It's in the 5s, 2 and 3 bedrooms. The 3 bedrooms are in the 5s as well as the 2s. They're brand new townhouses in a really good subdivision. Ngāi Tahu are the land developer. In my opinion, the best land developer in Christchurch and probably the South Island. This is a good deal, and there's not many of them. and they will get snapped up pretty quickly. We got an expression of interest on one of these just before the webinar started. So check those out. There's plans on our website. You'll see everything. Laneways Christchurch. This is in the heart of the city. It's across the road from the Justice Precinct, which employs 1,200 people. It's a boutique little complex, and we literally launched this 2 weeks ago. You can find this on Trade Me, and Harcourts will selling it for more than what we're selling it for. So we've got a genuine discount to retail on this, and it is a off the plan, settles late next year, boutique little complex right in the CBD. Location, location, location. Cromwell. We have 3-bedroom townhouses, and the twist with this deal is that Cromwell is a very crappy town when it comes to secondhand housing. The quality of the secondhand housing stock in Cromwell is terrible. It was a working men's town when they were building the Clyde Dam, and it is there's a lot of crappy product, and it's scary. So this place we are selling in the 6s to 7s, but it's brand new, 3-bedroom, 3-bathroom, and these can be rented to professional tenants or owner occupiers. And there's nothing like this in Cromwell. There's only 45 minutes from Queenstown. Tiara Wellington, dual key work and income. Commercial space downstairs, residential up, just under 800. This would be one of the best locations in Wellington. If you're in Christchurch, this would be like on Cashel Street. If you're in Auckland, this would be like Albert Street in Auckland. I think that the projected rents for these are ludicrously low, and you're getting 2 income streams for under 800 grand in CBD Wellington, brand new. Crazy cheap, and I think that's a good deal. So that is me. I'm just going to have a look if we've got any more questions. I'll stay online for another 10, 15 minutes for Q&As. Now, you know, when we did these events last week, we gave you a bit of paper. So if you liked anything you saw tonight, please just email us. One of our team will contact you tomorrow, and we will start the process of talking to you and helping you with your investment journey. At worst, log on to our website, join as a free member, and then you'll get access to our deals area, you'll get access to our members area, and it's just a bit easier to engage with us. And please give us some feedback. We'd love to hear what you think. We haven't done very many of these webinars yet, and yeah, we'd like to work with you. We have been probably a year and a half in the making for our latest website, and we think it's pretty cool. So hopefully you do too. So I'll stay online for another 5 or 10 minutes and answer any questions. But in the meantime, website, email, membership, jump on. I'll take a pause. Okay. Some people have asked, can we get recordings of these webinars? I think you can, but I'll get one of our technical people to answer that properly via email. But I do think, yes, you can get a copy of this presentation online, but I just don't know when. So, yeah, but look, somebody will come back to you if you email us. What else have we got? Christchurch. Somebody's asked about Christchurch, saying the, you know, there's a lot going on here, and there is, but population growth is back. Jobs are coming into the CBD. People are moving into new house and land subdivisions. 6 o'clock team. It's not 7, 8, 9, and 10. It's 6 o'clock. Best time to buy. What else have we got? Cromwell. Cromwell is a very hot location at the moment. Yes, you're right. And these townhouses, are they being built by a good builder? Yeah, they are. They're being built. They're steel frames and architecturally designed, owner occupier or family rent to family, or professionals. Because each bedroom has a bathroom, it's a sweet spot in Central Otago where couples will rent a room. So it's actually cash flow positive if you rent it room by room. So that's pretty rare in Central Otago, especially Cromwell. Not that many more questions. Does laneway have car park spaces? Good question, Jeremy. Yes, you can. They're not for every apartment. They're separate, so you can buy car parks separate. They're about 30-something grand. They're so cheap by national standards. Oh, someone's answered that. 32 grand, by the way. Someone wants to follow up on 3 developments. Okay, all that's pretty straightforward. Looks like David's been dealing with them. One other question. In my experience, how long does it take from just thinking about buying property to going through your due diligence program and getting funds approved? Good question. I reckon it takes 3 months. You can fast forward that if you're really motivated. But if I look at the average investor, they typically take 3 months to get going. And that's one of the reasons that we built this resource centre. Because, you know, if you want to rock in and talk to an accountant that's specialising in property tomorrow, they're probably not available. You probably have to wait a week to see them. And then that's the same with the broker. So I don't want to slow you down. And that's why we do give you a big, long to-do list to go off and see multiple people. But if you're already set up, it can be as easy as buying a property tomorrow. So you've just got to set your foundations up first. So the sooner you do that, the sooner you're investing. But that's okay. Property's a long-term game. There's no race. It's not a hurry. If you miss out on another deal, on a deal, there'll be another one around the corner. So yes, we've always got new deals coming up, Mark. And I bust my ass every week to negotiate as good a deal as I can. So it's not like I have a bad week and negotiate a bad deal. We like to think we're on the top of our game all the time because we love what we do. So I'm just going to mute myself, leave the questions over a little bit longer, and then I'm going to shut this thing down. And hopefully it was helpful to everybody who enjoyed it. Okie dokie, that is us for the evening. Have a safe rest of your week if you're driving anywhere. And hopefully this is informative, and we'll be doing more of these as we go. And look forward to seeing you guys as clients sometime. And thank you for the kind comments to those who filled out the text box. And see you soon.